শুনতে পাচ্ছো?
Sort of, yeah. I don't know how they can hear me.
Sir, we can hear you.
You can hear me?
Yes, we can hear you, sir. We are starting in a minute.
Okay.
তুমি অন্যটাতে দিতে করতে চাও? আমার একটা জুম আছে, আমি ওই জুমে চলে যাবো।
So it is my pleasure to welcome you all to the keynote presentation session of the second SANIM International Development Conference, what we call SIDC 2021 on COVID-19 recovery, context and priorities. So we are extremely delighted to have with us Professor Lant Pritchett as the keynote speaker. Professor Lant Pritchett doesn't need any introduction. However, in brief, I would like to say a few words about him. Professor Lant Pritchett currently is the RISE Research Director at the... I would request participants kindly mute yourselves. Yes. So Professor Lant Pritchett currently is the RISE Research Director at the Volatility School of Government, University of Oxford. Previously, he was a senior fellow at the Center for Global Development and professor of the practice of international development at the Kennedy School of Government at Harvard University. In 2017, he published two co-authored books through Oxford University Press. One is on the building state capability, and the second one is the deals and development, the political dynamics of growth episodes. He also published two solely authored books with the Center for Global Development. One is the Let Their People Come in 2006, and the other one in 2013, The Rebirth of Education. And over 100 articles and papers with more than 25 co-authors on a wide range of topics, including state capability, labor mobility, economic growth, and education, among many others. On a very personal note, I'm very fortunate to actually work with Professor Lant Pritchett. I was his co-author when we published the volume. Its name is Dynamics of Economic Growth, a Visual Handbook, from Manchester University in 2013. I also contributed a chapter to his Deals and Development book, which is published from OUP. And also I co-authored with him in 3 important journal articles. That, to have Professor Lant Pritchett with us, and his keynote speech, I'm quite sure that will be very relevant to the current situation. So with this, over to you, Professor Pritchett. We are eagerly waiting to listen to your presentation. Thank you.
Thanks very much for the introduction, and I'll be presenting some of the work that we co-authored together. So hopefully I won't get it wrong, such that you'll have to intervene. And so today, here I'm going to share my screen, which is going to, let's get to, I hope everybody can see that.
Yes, thank you.
So I'm going to not say, hopefully, anything about COVID until maybe the Q&A. And there's a reason for that. I think the reason for that is before we talk about COVID and the likelihood of COVID recovery and coping with the economic shock and health and other shocks that COVID has been, I think we want to take a broader view and step back and say, what do we know about the typical dynamics of economic growth? And how would that frame our expectations around what might happen as a result of the COVID shock? because the world has experienced all kinds of shocks to economic growth over the last 30 or 40 years for which we have data. And hence we shouldn't expect the COVID shock to necessarily be sui generis or a unique event in the history of the world, but rather is one in a long string of different types of shocks. And so I think before talking about COVID in particular, I think we should talk about the dynamics of growth in general. So that's what I want to do today. So I want to talk about that. I feel, and I haven't, followed COVID very closely, but the conventional wisdom in general, and I think specifically about COVID, has really been based a lot on rich country growth dynamics. Oftentimes, the paradigm within which people are talking about how to respond to things is built on a model of Denmark or Germany or the United States as being the paradigm country, and the growth dynamics being the growth dynamics of that country. And one of the things that I have tried to document for off and on for 20 years now is that the growth dynamics are fundamentally different for developing countries. And so I want to present the ways in which they're fundamental, and then a little bit of the two key ways in which I feel the growth dynamics are mismodeled by extrapolating from rich country to developing country dynamics. So two key features. And then at the very end, get to sort of, are there therefore different lessons about what should happen in response to a shock? So first thing I want to is do a little exercise, which is suppose that I had a country, I take a country like Denmark, and I take Denmark as a kind of prototypical rich country. And suppose I had 10 years of data from 100 years ago. I had data from 1890 to 1900 for Denmark. And I did a simple trend extrapolation on the basis of those 10 years, 100 years in advance. So I'm predicting Denmark's GDP per capita 100 years in advance on the basis of just a simple trend of 10 years, 100 years ago. The question I want you to think about and maybe even write down somewhere, because I'll give you the answer in a minute. And if you don't write it down, I know for sure you'll say, oh, yeah, that's what I thought. So how far off in terms of absolute percentage, in terms of percent in absolute value, you can think it would be high or low. What would be your expected forecast error of a 100-year ahead prediction of the level of GDP per capita? And I could hum, I guess, the Jeopardy song. But I'm going to give you a few seconds. Well, it turns out your 100-year forecast based on a regression of data from 1890 to 1901 would have been off by 3%. You would have forecast Denmark's GDP 100 years ahead with just unbelievably high accuracy. You see on the left-hand side, there's the dotted line is the prediction, and the solid line is the reality, and the two numbers overlap. The predictions are so close. And the reason for that is that what I call all happy families are alike. The novel, Tolstoy's novel, Anna Karenina, starts with the famous sentence, all happy families are alike, but every unhappy family is unhappy in its own way. But if you look at the evolution and the growth dynamics over the long period, at least since 1870 to the 2000s of the rich countries, they all look pretty much fundamentally the same, which is they all grew at about 2% per capita, and they all grew at 2% per capita amazingly steadily for a very long time. And what I mean by amazingly steadily is that even massive negative shocks, and it's not, you can see the solid line deviates from the forecast around 1920 because there was something called World War I. It was a massive shock. You see the line dips away from the trend line for the Depression and World War II, which were, again, massive shocks to the Danish economy. But then after that, it actually recovered very strongly. You see a very strong recovery in the immediate aftermath of the war, and then continued to recover. And again, by 2003 was exactly where one would have predicted it to be, as if there had been no shock. So one of the, again, amazingly strong features of developing country growth, and I can do this same graph for nearly every OECD country, and they all look almost identical, is the amazing trend reversion to a steady trend. There haven't been big ups or downs in the trends of the rich country growth. So if that is your kind of expectation of the dynamics of growth, that whatever the negative shock is now, I will expect over some time period to return to the previous trend, then kind of the obvious policy recommendations in response to every shock are roughly the same, which is shorten the, undertake the policies in response to shock that shorten it as best you can. Meaning if it's a health shock, handle the health issues. If it's a price, if it's a weather shock, cope with the weather shock. Whatever the optimal policy response is to shorten the shock is going to be desirable to do. And then you should probably borrow to smooth consumption, because if you have had a negative shock, but you anticipate you return to trend, you can borrow when red is really low and keep consumption at orange, and then you'll have to pay it back in the future. So since it was a negative shock, long run consumption has to go down a little, but you can smooth the shock over time by borrowing in response to a negative shock. And I think that's, again, I have lived my lifelong ambition of not being an expert on COVID. So I have not even attempted to become an expert on COVID. But I think this is roughly the conventional wisdom of the OECD countries, which is let's handle the shock, vaccinate, get over the shock as best we can. And in the interim, the governments are going to borrow unbelievably massively to smooth consumption in response to the shock. So now it turns out, and this is a series of graphs that we produced about that kind of characterize growth of countries. And there's 4 different ways of characterizing the growth of the country. In the top is just the trend line. And this is showing GDP per capita growth since 1950 to 2010 for the Netherlands, switched from Denmark to the Dutch. And this is, again, what every OECD country looks like. You see they kind of had rapid growth up to about 1975, which was part of the recovery from the war, a long period recovery, followed by a return to the mean, and they grew at 2.3% per capita over this entire period. The Northeast graph shows you where Netherlands was relative to all countries of the world with sort of standard error bounds. Typical growth in the world was about 2 with a standard deviation about 2. So Netherlands was right on the kind of predicted, by growing at 2%, they stayed exactly relatively where they were. The Southwest graph shows the first differences, like how variable over time growth was, which was not very variable. And then the bar chart shows what was the distribution of growth episodes. If we chunk growth up in the Netherlands into 5-year periods or 8-year growth rates, and we take every growth rate as an observation, what's the distribution? And what you see is nearly always over every 8-year period, Dutch growth was in kind of near 2%. They had kind of slow growth sometimes, they had some episodes of recession, but they never really had super rapid growth, they never really had extended collapse. So everything that's true about Denmark and the Netherlands and nearly every OECD countries is not at all true of the growth dynamics typically experienced outside the OECD, which is, first of all, there's massive volatility within countries over time, which is, if you look at the the graph over time of GDP per capita, it's not some steady hill that kind of creeps upward at 2%. It usually is boom and bust, in which sometimes there will be episodes of really rapid growth, sometimes there are episodes of stagnation, episodes of slow growth, episodes of recovery. And that average growth rate varies a lot across countries. So the standard deviation of growth among non-OECD countries is much larger, with some countries with very rapid growers with sustained growth of 6 or more for extended periods, and some are long-term stagnators. Some countries just stagnate. So if we look at the same kind of graph on exactly the same scale, by the way, or the same logarithmic scale, so you can compare these directly across countries. This is what a country like Nigeria looks like, which is its trend line, its trend rate of growth is exactly 0, but it's not because it was always growing at 0. Rather, its trend rate of growth over the long term is 0 because it has periods of boom where it grows very rapidly, periods of bust where it contracts very rapidly, that are interspersed, so that you see that Nigeria's relative position slipped relative to all other countries because it grew very slowly. You see the first differences of growth are enormous. The volatility of growth year to year is enormous. And if you look at the bar chart, you see that Nigeria's distribution of growth episodes has more variance than the distribution of growth episodes around the world. So in a weird way, in any given period, Nigeria looks less like itself than the world distribution. The variance of growth episodes of Nigeria is larger than the variance of growth episodes of all countries in the world. So if you knew that this country was Nigeria and were attempting to predict an 8-year growth rate, knowing Nigeria actually would increase the variance of your growth, not reduce the variance of your growth, which is, again, hard to wrap your head around. That you would think if I knew what the country was, that would help me predict what its growth rate was. But for an 8-year episode, that's just not true. Knowing it was Nigeria would just increase your variance, but not improve your ability to predict. So if we look, therefore, we sort of bin the data up and into kind of 2 percentage points units. So we have collapse, which is you're falling faster than 2, stagnation, slow growth, moderate growth, 2 to 4, rapid growth, 4 to 6, and a boom. What you see is this is the distribution. The OECD is incredibly concentrated in 2 to 4, right? Or countries are concentrated, and nearly all of that is the OECD. There are very few countries besides the OECD in that box of steady at moderate growth. One of them is Colombia. We do see some stagnators and collapsers who spend most of their time in the negative growth rates. But then what we see is a lot of countries are in this boom or bust, whereas we look at this distribution of the time they spend in these various growth regions, it's all over the map. Ghana, of the 5-year growth episodes, Ghana spent 7% of its 5-year growth episodes in a collapse of more than 2% a year, and 11.6% of its 5-year growth episodes growing faster than 6%. So literally Ghana spans the distribution of possible growth episodes, and it's in a boom or bust context. And then a very few countries, actually only 8 of the 120 countries we have data for, are rapid growers, where they spent most of their time in growth above 2%. So what that means is, if we think of, and this is a graph that I've developed. There you go. If I show pictures, I get good reactions from somebody anyway. So what this is on the horizontal axis is the growth rate, which is, scaled from 2 percentage point is kind of the center of the distribution. But we have very rapid growth countries that grew very rapidly on average and countries that grew very slowly on average. But then on the vertical axis, we have the volatility, which is the range of growth rates a given country experiences. So take, all possible 10-year growth rates and ask what's the difference between the fastest and the slowest growth rates. So a steady moderate grower is that box in the middle. And if you look in the box in the middle, that's a lot of OECD countries. If you look there, New Zealand is in there, Hungary is in there, and a few other countries are in there as well. But most of the experience of growth falls outside of this kind of steady, moderate grower. We have some reasonably steady, very fast growers. On the far right, you see Taiwan. We have some reasonably steady collapsers that have roughly been in stagnation. On the left, you see NER, which is Niger or Madagascar. But we also have countries that grew very fast and very slow. So China during some of this period grew very slowly and then grew very fast. On the other hand, we also have countries that on average grew slow, but had periods of boom. So the upshot of all of this is the kind of, the way to think about economic growth is, so I'm going to use a metaphor, a physical metaphor. So what would happen if I were to dump a bucket of water on my head? You envision myself picking up a bucket, right? Now, probably what most of you envision is that I would get very wet. But if the water in the bucket was less than 32 degrees, it would have become a solid. And it would have undergone a phase transition from liquid to solid. And when I turned it upside down, it might not even come out. And if it did, it would hurt a lot because it would clonk me in the head. So the important concept, though, is the phase transition. Water has certain dynamics when it's in a certain phase, meaning the phase of being liquid. And then it has completely different dynamics when it undergoes the phase transition of freezing up. Once it is frozen, everything about the dynamics of water changes. So if I ask, how quickly, if I drop a marble into the bucket of water, how quickly will it sink? That has some answer for a bucket that is fluid. And it might be the answer is a little bit different if the water is warm versus the water cold. It might be a little bit different if the water is mixed with something or not mixed with something. But when the water is solid, the whole question of the dynamics of how something is going to behave with respect to water changes. The marble doesn't sink at all, it just sits on the surface. So I think the thing people need to wrap their head around is that developing or emerging market countries have phase transitions. Their growth processes are characterized by sharp, often massive, discrete events at which the process of growth goes from being in one phase to being in a completely different alternative phase. And hence, the typical decomposition that economists do with OECD countries into trend and cycle, I feel is just completely unhelpful because the trend and cycle decomposition it depends for its usefulness on being able to identify and rely on that there is a more or less unchaining underlying trend relative to which cycles happen. Whereas as growth processes evolve in developing countries, it's almost impossible to distinguish what is a downward cycle relative to a steady trend versus what is the initiation of an episode of stagnation or the initiation of an episode of a downward cycle in which the trend rate of growth has fundamentally shifted. And again, these phase transitions are sharp, discrete, massive, and persistent. So we're not talking about that there's a volatile business cycle. It's a completely different characterization of the growth process. So now, just as a preview of coming attractions, what that means is when an OECD country has a negative shock, we might retain nevertheless, even though growth is 5%, 6% below current trend, our forecast of where it will be in N years, where N is 5 or 10 or 20, might not budge at all with respect to the negative shock. We might say, yeah, growth is down, but my forecast variance of what growth will be 10 years from now hasn't budged at all. It will return to roughly the trend line, and I am saying that with very high levels of confidence. Now, if in fact you can, if in fact your forecast of N year ahead GDP per capita isn't very sensitive to current conditions, then you can react to shocks in a certain way. On the other hand, the difficulty is that when developing countries experience a shock, it is almost impossible to distinguish ex ante whether that shock is a transitory shock and the economy will return to its previous trend, whether that shock is the harbinger of an extended period of stagnation, which is the dotted line, whether that shock is the, again, harbinger, the first symptom of a crisis that's going to evolve over time and GDP is going to get lower and lower and lower and it's going to be in a downward spiral, or whether that shock will induce a quick and decisive policy reaction that addresses not only the shock but underlying causes of slower growth, and you'll follow the shock with a boom, which means if you look across the possible red line outcomes, the N year ahead forecast can be anything. It could, these numbers, and I'll show you real live numbers in a little while, but relative to the trend, the persistent trend shocks we observe in the world, the top line and the bottom line can be 200 percentage points off. So completely unlike Denmark, which happened to return completely so that we could forecast its 100-year ahead GDP with ex post, at least with high confidence. We have no idea whether a current contemporaneous shock is going to be 10 years from now more, erased, more than erased, or whether we will be exactly the shock in level. So let me just talk a bit about the research that I did with co-authors, including the moderator, is we did a two-step procedure. We said, how are we going to disentangle kind of these phase transitions so that we can show? And what we did is we kind of asked the data to tell us, where would you like this trend to be broken so that we could identify phase transitions? And once we had identified phase transitions, we could, for each country in the world, break its episodes into how much did that particular episode contribute to growth. So here is just an example from Brazil. The red line running through the graph is sort of our counterfactual prediction of what growth would have been in Brazil in the absence of the shock. And then the blue joined lines are our growth in the particular episode. And then the green line is the actual evolution of GDP per capita. And so what you see is the statistical procedure therefore says there were basically 4 episodes of the growth experience in Brazil from 1950 to 2010. In the first one, Brazil was growing at 4.6%, which was faster than predicted. In the second one, from 1967 to 1970, it grew even faster. It accelerated to over 5 percentage points. And this wasn't because, in some sense, the counterfactual was predicted faster growth. It just had a genuine growth acceleration. In 1980, it had a growth stagnation that lasted 20 years. So from 5% growth from 67 to 80, it went to 0% growth from 1980 to 2002. And then in 2002, growth resumed, but at a modest pace. It only actually resumed at the level that kind of would predict. And so what is shown below is the kind of contribution to the difference of Brazil's level of output in 2010 relative to the counterfactual of not having a shock in each period. So as you see, the green bar is the first 2 positive growth episodes led Brazil's GDP to be higher than it would have otherwise been. Then there was this big red box, this big red box in the bottom graph, particularly the southwest graph, the bottom left graph, is that shock erased essentially all of the previous progress, so that by the end of the period, Brazil was lower than we would have expected had it had none of these growth episodes, and then only slightly recovering with the last growth episode, because even though Brazil went from stagnation into an episode of growth, it really wasn't fast relative to what the counterfactual predicted. Now, the main point of this is that we can do this for each country, and we just see that there are just these massive differences in how much difference a positive versus negative growth episode can make. So this is Indonesia. Indonesia, when we, again, do the same, for each country, we're doing the same statistical procedure, but it's decomposing growth of the country into these episodes. When we do the procedure for Indonesia, you know, level of GDP in Indonesia in 1996, when the growth episode ended, was a full log unit higher than it would have been otherwise. So just massively higher. By the same token, if we look at the kind of the worst decelerations, we can say, what's the loss in GDP relative to the counterfactual of no growth deceleration? And there are, you know, 15 episodes in the data in which GDP was half what it would have been had you not had the growth deceleration. So if you now think that graph I showed you earlier, you know, if in the period at which the growth break happened, you got Indonesia's outcome versus, say, Malawi or Iraq's or Jordan or Nigeria's, you're producing, being at the end of the episode, you know, double what you would have been versus being half of what you would have been. So when you have, so the growth breaks produce just enormous differences in the outcomes. So I'm going to skip some things. And this is just going back to showing you that these growth breaks, these are kind of just how disastrously a growth break can go. So this is comparing Liberia to Africa, the rest of Africa. You know, lots of countries in Africa had a negative downward turn in the 70s, but Liberia's went from being kind of the average country in Africa in the 1970s to just complete total implosion, loss of civil order, complete reversion. And this is just another example of how these differentials lead to just incredibly long run differences. In the 1960s and 1970s, Spain, which is the blue country, and Venezuela, the red country, had, well, actually, Venezuela had substantially higher GDP in the 60s and 70s than Spain. There was pretty massive migration from Spain to Indonesia because wages were so much higher, and from Spain to Venezuela because wages were so much higher in Spain. But in the 1970s, there was a negative growth shock to the growth process in Venezuela, from which the country essentially never recovered. And from 1978 to 2000s, Venezuela stayed in a downward spiral. Spain recovered, then had a very long and extended boom. And even with the massive volatility of the financial crisis, Spain, which was one of the worst hit countries by the 2008 financial crisis, had a massive downward turn, but A, was still massively higher than Venezuela, and B, recovered from it very quickly. So what I'm trying to convince you is that the growth dynamics of the rest of the world are mostly, and for the most part, completely, totally different than the growth dynamics of the OECD. The OECD can be completely and accurately decomposed into trend and cycle, whereas the growth dynamics of most developing countries are not at all well characterized by trend and cycle, and that these growth dynamics are episodic, lead to discrete phase transitions in which the growth process and its characters change. Which then means if we were to have a theory that accurately described growth dynamics, we would need a theory that's very different and has very different features than the ones we use for OECD countries. So the standard economics we use for OECD countries just can't possibly be a good representation of the growth dynamics of poor countries because the facts about their growth processes are so different. And I think there's two fundamental differences in the way we model growth dynamics between these two, that way we should model growth dynamics between these two countries. The first is that one of the things that characterizes many countries is that they have what I call weak state capability or weak capability for policy implementation. And by weak capability, we mean they have little ability to make policies and actually have them enforced that are in ways that are reliable over time and uninfluenced by corruption and other kind of influence activities. So, which doesn't necessarily lead to bad outcomes, but it does lead to something I call deals capitalism. And what I mean by deals capitalism is if you ask yourself as a firm, what's going to happen to me? The answer depends on who me is. You don't say what's going to happen to my investment doesn't depend on the law in some abstract sense or the legislation or the policy. What happens to me because it's me, in the sense that I am connected with the political or regulatory process in certain ways, such that I have struck a given deal, such that my expectations about what will happen to me is different than the neutral application of the law, versus a more or less rules capitalism in which most people expect that what will happen to them and their investment and it will roughly look like that rich countries also have deeply politicized economic policy and that there isn't differential and favorable treatment. But for the most part, OECD countries have the stability they have because they have a rules capitalism in which the law is roughly expected and the law can ground expectations. And to some extent, and then the second thing is, I think the way we represent the growth process is often derived from a solo model of factors and TFP. And I think that representation just can't account very well for the growth process we exactly observe. Whereas the capabilities approach to structural transformation that has been developed by Ricardo Hausmann has a completely different characterization of the production function in which factors combine to produce an array of different products. And I think that characterization of the production function is much easier to accommodate the growth shocks we actually observe. So I just want to talk 1 second about the dynamics of deals capitalism, because the main thing about deals capitalism is there's different types of deals capitalism between open and closed. And by open and closed, I mean, there might be a deal, but it's open to everyone. So it might be that in order to get a license, you have to bribe someone, but everybody can bribe someone and everybody can get the license, versus closed deals in which you basically know the last name of who's going to do some particular economic activity in advance because of who they are. So if one were to say, in Egypt, there's going to be some 5-star hotels built on the coast of Sharm el-Sheikh, you can predict in advance who the engaged Egyptian actors are because there's only a certain very limited range with whom it was going to happen. Then those deals can be ordered or disordered, meaning ordered deals just means if the deal is done, it stays done. If you pay a bribe and get a driver's license, no one comes out ex post and invalidates your driver's license. You have a driver's license, it's ordered. Same thing with cronyism. You can have a kind of stable cronyism. And then there's disordered deals, which is mostly the informal sector in most countries. And a closed kind of disordered is many fragile states. There's a rare group of people that try and monopolize the rents, but their control over those rents is very shallow and thin. I'm going to skip ahead a little because I did want to stick to roughly 40 to 45 minutes of presentation, and then we can handle more things in the questions. So, but let me just talk briefly about Hausmann's characterization of the growth process. He thinks of the product space as being all possible things that a country could produce, as characterized, say, by the export classification structure. And then he thinks of a country's location in the product space, in the export product space, as being the products it's actually producing. And your location in the factor space is the result of capabilities. And countries have more or less large sets of capabilities, and capabilities products that require lots of different capabilities are called complex, and structural transformation is countries acquiring the capabilities that allow them to produce more and more complex products. Now, the reason this is important is this is in some sense the polar opposite of the mathematical characterization of the solo production function. If you think of the solo production function, there's very few factors that combine with unit elasticity among themselves. So there's this hunk of stuff called capital, and there's this hunk of stuff called human capital, and there's hunk of stuff called labor, and it combines with unit elasticity in some aggregate thing. Whereas Hausman's is more a detailed product by product Leontief production function. In order to produce a given product, you need to have the following capabilities, and it's a very long list, not a very short list, and hence one can't easily aggregate. Now, the important thing about understanding the product space is that if, depending on where you are in the product space, there might be lots of things near you, products that require roughly the same capabilities, which makes it easier for you to undergo structural transformation and acquire new industries. Or you could be in a very sparse part of the product space where there just isn't a lot of other things near to you. So you have these countries in the bottom left, they have very few capabilities currently, and the capabilities they have are very far from other capabilities. So for instance, resource dependent and mineral dependent economies, it could well be you mine diamonds. And mine diamonds provide some amount of export revenue, but mining diamonds isn't a lot like anything else. The capabilities it requires to mine diamonds is having diamonds and then having the ability to mine them, but that doesn't naturally lead to or isn't consistent with the capabilities that need for other products. Whereas other countries are very solidly in the export product space where they both have a lot of complexity and they can, and they're still near lots of other new products. Whereas the rich countries eventually get to a stage where they've got all the capabilities they need. So the upshot of all this is, the upshot of this is that if you are stuck in a sparse part of the product space and you have a negative shock to your product, you are just in deep, deep trouble. Because it's very hard to reallocate. It's not like you have these factors that are reallocable to new products. It's that you had a set of capabilities that were devoted to a given product. You weren't close to or reallocable to other products to immediately acquire capabilities. So for one reason why we get huge negative shocks out of an initial shock is that often negative shocks happen to countries that have few capabilities. It's very difficult for them to reallocate and create the new capabilities to restore growth. Whereas for the very rich, high capability countries, their space in the capability space is so broad that a negative sectoral shock to any given sector, they can reallocate capabilities across sectors easily. So I think these two things account jointly for the very different dynamics we observe between stable countries that by and large have a massive array of capabilities such that the sectoral nature of the shock is relatively unimportant. Second, they have, a rules-based capitalism in which there aren't massive shifts to expectations such that a negative shock creates the fear that this is now the beginning of an episode which could become a self-fulfilling prophecy. So they both have a stable production function and a stable, dare I say, institutional environment for carrying out economic activities, whereas in other countries, both of those may fail to be true. So now I just want to go to revisit the organizing kind of question. Let's revisit the conventional wisdom of coping with negative shocks, which is shorten the shock, borrow to smooth. It might still be right, but it might be very, 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 very wrong. Meaning, I think you have to ask yourself about a country experiencing a shock, three things. One, can the political settlement, that is, however it is that power is allocated and organized in the society around which legitimacy and stability of the political structure is generated, can it actually survive the shock? So what happened in Liberia is there was this kind of few export crops. The rents from those export crops were shared in a certain way. Once the shock to that net export revenue from the resources was large enough, they lost the ability to sustain the equilibrium in which people were kind of bought into the current system by the reallocation of the rents. And once that happened, you didn't go from, GDP of 100 to GDP of 98. You went from, average GDP in Africa in the 1970s into just the dark ages because central authority completely disappeared. So we can't just assume that even the underlying deal structure that is currently what's sustaining the level of GDP can survive the shock. And I hesitate to use, but I'm going to use the example. Peru just elected as president, in part, I think, because its COVID shock has been so severe, someone who just has no previous experience at any kind of political or other management. And I think it's just the political structures that were there in Peru couldn't survive the magnitude of the shock. The second is, mostly with shocks, we ignore the sectoral nature of the shock. But I think you do have to ask yourself, does this shock, has it fundamentally changed the attractiveness of the part of the capability space I'm in? So, it could well be that a shock like COVID hits some sectors worse than other sectors. And if those sectors happen to be sectors in which your economy was specialized, you have to ask yourself, is that coming back? Or is this a deep long-term shock to the good in which I had kind of my capability, in which case your response has to be wildly, radically different of creating new capabilities. And finally, you have to ask, can my country really borrow enough not to have to worry about the dynamics of the shock? Because as we looked up above, if you start to borrow to accommodate a shock, but the borrowing itself kicks off a cycle of expectations that no one is confident growth will resume and growth doesn't resume, you can, having borrowed into a shock on the premise that it was transitory is the way you can often get yourself into very deep and long-lasting economic troubles. And so excess borrowing on the premise that it's a transitory versus permanent shock is a really bad thing to get into. And so on one level, everyone wants the COVID shock to be short, discrete, over with, and borrow against it to smooth consumption. But if in fact this represents some fundamental shift in the economic process in your country, staying into that strategy very, very long is going to lead to much worse problems down the road. So, and finally, I just want to say, and this is the last thing I'll say, is that there's a very recent good book by Mervyn King and John Kay, kind of revisiting the concept of Frank Knight that we need to distinguish between probabilistic uncertainty and what they call radical uncertainty, which is the kinds of uncertainty that doesn't lend itself well to probabilistic thinking, because probabilistic thinking and evidence depends on there being a large number of repetitions of roughly the same thing. So we can think well with probability about rolling a die because the rolling the die outcomes are enumerated and numerable, and we have rolled dice for thousands of years. Whereas radical uncertainty is just nobody really knows what's going to happen. And as they point out, probabilistic uncertainty produces puzzles, which is we're not quite sure what the right answer is, but we're reasonably confident there is one and how to get to it, versus mysteries, which is the big question in mystery is what is going on here. And I worry that oftentimes we want the world to consist of puzzles, to be easily knowable, resolvable, we can make decisions, but we want to make sure that we're considering the range of alternatives, because what we have in fact seen in the world with respect to economic growth dynamics is that anything that can happen has happened, and has happened often in ways that no one at the time the first shock happened, anyone would have predicted it. So I don't think anyone in 1978, as growth started to turn down in Venezuela, but Venezuela was still richer than Spain, would have imagined that 40 years ahead, Venezuela would be hemorrhaging refugees and wheat would be falling because Venezuelans literally couldn't feed themselves, while Spain would be firmly in the club of rich and EU countries. So I think we just want to keep open the possibility that growth, we should be wary of assuming that growth dynamics are going to be happy family growth dynamics that are easily predictable. And we should at least entertain, how would we know whether or not we're headed into some unpredictable area of growth dynamics, and do we have ideas about what we can do to avoid the worst outcomes in those dynamics? So thank you very much. That was the presentation I had. And I'm happy to now devote the rest of the time to Q&A.
Thank you, Professor Pritchett. I think it was a very kind of provocative presentation, especially given the current context where you talked about the deals environment and the state capabilities. I'm quite sure that these two are very, very dependent in your views that, the recovery process in the developing countries, especially as you mentioned that the OECD and the non-OECD countries probably will see two different trajectories because of the deals environment and state capabilities. But these two things, they don't really develop overnight, and the change, especially from moving from deals to rules and the state capabilities. And there are many factors behind it, why, how they are being determined, why even among the developing countries, we see there are many differences. So definitely we'll come back to you and there will be many questions too. But before that, may I request, I'm asking Professor Hemant Suban, would you like to speak now, or sir would like to speak a bit later? Probably a bit later. Okay, so I'm inviting questions. If anyone, please, Professor Mustafizur Rahman. I think some in the chat box, probably there are already some questions. Probably Mr. Abdullah Shibli would like to unmute and ask the question. Mr. Abdullah Shibli, or I'll read it out.
Okay, thank you. Can you hear me?
Yes, we can hear you. Yes.
So I would like to thank Sainem and Professor Lant Pritchett for the very interesting presentation. My question is relating to the somewhat pessimistic predictions that I can garner from your concept. My simple question is it possible for developing countries, and I come from Bangladesh, even though I live in Boston, whether Bangladesh can, or Southeast Asian countries can do something to break the not so optimistic future that I can see from your modeling because of the structural uncertainties. Thank you.
Thank you. Professor Pritchett, would you like to answer it now, or we'll take a couple of more questions?
So
yes, we can. Yes.
Let me take that one, and let me combine it though with a point that you made before we opened for questions, which I think is very important, which is, whenever I skip a slide, I remember why it was in there. One of the really important things about the deals versus rules dichotomy is that economists, I think, and others have been very caught up in the world of let's make new policy. Let's respond to things with policy. But if you think back to your economics training, and I'm assuming everybody here has roughly had some economics training, there is the phase dynamics of what's a jump variable and what's a flow variable. What's a stock and what's a flow? Or, what's a price on a financial market that is pricing the future, and what is the stock of some physical reality that can't jump? And so, we all, or at least a lot of us, when we talk about exchange rates, you have models of exchange rate overshooting, in which the exchange rate in response to current shocks, jumps immediately to a saddle path that leads it to the balance of trade in the future. But since the capital account and current account are, accumulate over time, but the asset price of a exchange rate can move very quickly, the exchange rate jumps around. The analogy here is that oftentimes policies in the de jure legislative sense are like jump variables. It's easy to make a policy. I can change the policy about property tax collection, higher rates, lower rates, different valuations, whatever. But unless and until I have a tax agency that can enforce that legislation in practice, the policy doesn't actually have the predicted impact. So as Salim was saying, the capability to enforce rules isn't a jump variable. You can't jump from a deals environment to rules environment by making new rules. You actually have to accumulate the capability, and capability is a stock. Organizations have capability when it's accumulated, and it's a stock that tends to accumulate very slowly. So I think when we say optimistic, pessimistic, we need to be thinking in a long run dynamic sense of, are we on a path in which we are jointly improving outcomes and accumulating stocks of capability, in which case you can be on a very positive trajectory, even though kind of in the current messiness of it, it might seem like capability is very low and messy. But imagining that one can just jump to rules environment by changing the legislation about doing business or something, I think is a fool's errand. You can't invent capability overnight. You can change legislation overnight, but capability is a long, hard slog. So let me get to the second question. Nothing about what I was trying to do was not optimistic versus pessimistic. I was trying to increase your variance in the sense that once you increase the variance, there are countries in the world like the Vietnams, Chinas, et cetera, that have grown a factor multiple faster or longer than any other country in the history of the world. So to some extent, there is a massively optimistic upside to the growth shock story. It's just, I was sort of a little more focused on the potential downsides because most countries in the world with the COVID shock are experiencing a negative shock. But like I say, in general, what I'm saying, I don't think should be taken as pessimistic versus optimistic about the developing world generally. It's that the divergence of fortunes is going to be bigger depending on whether your country gets into a positive growth dynamic or a negative growth dynamic. And so that, the range of outcomes that gets generated by the OECD countries is very narrow, whereas the range of outcomes that has been generated over the last 50 years by the growth dynamics of phase transitions and episodes has been enormous. That said, I think on average, the developing countries have done well, and more so in the last 20 years. I think in the last 20 years, there have been more countries in the kind of rapid convergence category than have ever been there before. That said, I think when you increase the variance, you should be aware that I think overconfidence is the main policy risk here, in that you say, here's how I'm going to respond to a negative shock, and you are responding to negative shock in a way that implicitly embedded into it is some assumptions about what's going to happen in the future that may or may not pan out. So I guess what I was trying to do is increase the amount by which you recognize the radical uncertainty of the current world context, in which I don't think anyone at this stage can forecast with any accuracy what's going to happen to the overall global climate for growth facing countries like Bangladesh. And hence Bangladesh needs to consider, I really don't want to talk too much about Bangladesh, because as I look at names on the screen, I'm guessing that more than half of the audience knows more than twice as much about Bangladesh way more than twice as much about Bangladesh than I do. But I'm saying a country like Bangladesh, for instance, that has had actually really pretty good growth experiences over the recent period with relatively what most people would regard in the standard indicator as relative weaknesses, but with certain really strongly booming industries, right? There is the assumption that, look, you know, the OECD is going to recover from this COVID thing and we're going to go back to having the same success with the same sets of exports that we've had in the past. But one should at least be considering the kind of openness to the uncertainty that that's never coming back, that the trend rates of growth that have been experienced in those industries, maybe this shock is going to reorient global trade, reorient consumer preferences, reorient trade links, reorient overall stances to the global economy of the rich world in a way that the niche of success within what Bangladesh has been building off disappears entirely into the future, and have at least some sense of how would we know if that's true and how are we going to react to it if it's true, right? Because what you know, as they say, it isn't what you don't know that kills you, it's what you do know that ain't so. And hence, if you keep making plans on the presumption that, you know, the world's going to go back to normal and it doesn't go back to normal and you haven't formulated either any feedback mechanisms of knowing whether it's getting back to normal or any plans for what's our plan B contingency of how we hope to move Bangladesh's capability space to be able to continue export success in a new and different world, I think that should be hugely central on nearly all countries' agendas now is, are we ready to know how quickly our set of capabilities is going to re-engage into the world economy, and do we have a contingency plan if they don't? I'm hoping, if what I'm saying is unclear, I can be maybe even more brutally straightforward, but I'm trying to be both careful but clear.
Thank you, Lant. We'll take questions from or comments from Professor Eman Sohan. Sir, over to you.
No. Well, a more general one and then getting specific. You see, if I understood the way you frame the argument, you're essentially looking at the capacity to respond to shocks based on, one, your capacity to live by rules rather than deals, and secondly, also by the structure of the economy and related to the sort of density of your sort of production structure, which gives you a degree of resilience to, in fact, sort of cope with shocks. Now, what is not clear to me is the way in which you situate different types of shocks, because obviously shocks are not the same. I mean, if you're looking at the conventional shock coming from changes in the business cycle, which are imposed on you exogenously coming from the international system, it may require different sorts of capabilities and responsibilities. If you're talking about a country which suddenly sort of descends into external conflict or even sort of internal civil conflict, this will have another type of impact. Or, of course, when you deal with a situation such as COVID, where you are partially influenced by the exogenous shock coming to you from loss of markets for particular products, and you are dealing with a different set of problems where your domestic economy is reacting in a much more stable way. Now, the ways in which you will respond to this will depend greatly on the nature of the policy-making apparatus and the capability of the policymakers. And here, the relevant question would then emerge. as to how different countries would react under those circumstances. Now, on the one hand, you have both China and Vietnam, who have developed, who've obviously demonstrated considerable resilience in their capacity to react to COVID by the way in which they have in fact managed the COVID crisis. But also, this relates to the way in which they've handled their domestic economy now. Partly the way they have come out of the crisis economically is initially by limiting the shock of the COVID. But beyond that, much greatly depends also on the geographical configuration of their markets and the structure of their economies. Now, where in the Asian region you have a dominant economy like China with strong value chains constructed, the whole range of countries around it, if China has been able, both through its policies in responding to, say, COVID, and also the density and size of its economy, because obviously the larger your economy, the larger your domestic economy, the more you can sort of internalize your response and take control over it, as distinct from one where you have got a high degree of external dependence. But in the Asian case, if a lot of your external dependence is tied in with your value chains with China, and you then have one country in the middle of this region, which has got a stabilization influence, then you may have a different set of results. I mean, obviously, when you had the post-2007, 2008 crisis, Asia reacted very differently from other parts of the world, including Europe and North America itself. And central, certainly, to the Asian response, particularly in the Southeast and East Asian region, was the fact that China was their main trading partner, and China provided the stabilizing influence to respond to the shocks which took place. So these essentially look at the problem from the point of view of economic structures, but doesn't really figure in evaluation of the nature of the economic system, where, of course, you have somewhat simplified the problem by looking at it in terms of your capacity for rules and deals. Now, I don't quite know how uniform that is and how that would be made to apply if you looked at a range of countries and sort of binomially, in fact, distributed them under these two heads. But you would have to get into a effective understanding of the political structures and dynamics of that particular country, in addition to its external trading relations. So everything over here is contingent then on where you might be located within the global system, with whom are you sort of doing your business, and your own capabilities in terms of both your production capacity as well as your political skills and capability in actually dealing with the situation. Bangladesh, for example, has more or less had reasonably stable and consistent growth now, not just recently, but really from the beginning of the century, over 20 years. Now, this has all happened in spite of what you would regard as a lack of rules and a considerable dominance of crony capitalism within the system. Now, how you would reconcile these propositions, because its external economy is also highly dependent on a single export of ready-made garments, mostly directed to Europe and North America. But we have still managed to come through this process. And whether, in fact, we are handling the COVID effectively, of course, much really depends on the accuracy and reliability of the growth rates which are being presented to us by the government. I mean, there's some debate as to whether these growth rates are correct or whether they themselves are managed growth rates. We don't know, but we can assume that you are having a growth rate which is demonstrating a degree of resilience to the system. But what is asymmetrical, what in fact lends a problem with the application of your model is you have a model which is not universal in its applications, but which then really becomes dependent on the nature of your geographical location and the nature of your economic structures in your politics. So I would like your feedback on that. And central to this would be how within your system would you locate the new and major player in the game, which has China, which in fact has given stable growth over longest period probably in human history, and has therefore impacted on a whole group of regions around it. I mean, obviously, the future of Bangladesh may well lie in its ability to be able to get properly plugged into the Chinese value chain. At the moment, we are only plugged in via our import dependence on China. But what you would want to do is to be able to diversify your exports away from Europe and North America, which are much more prone to trade instability and economic instability than China is. And if you could do that, then we may well be operating under better circumstances, which would hold good as long as the country doesn't degenerate into a major civil or political crisis because of its internal problems. I leave these thoughts with you. They are not very well organized, but I look forward to how you respond to my ideas.
Yes, Professor Pritchett, you can. Of course.
Yeah, I hope. So one of the things I want everyone to understand is that one of the things I am emphatically not saying is that growth prospects are better in rules economies than deals economies. All of the rapid growth episodes that have happened in the world have happened in what I would characterize as closed order deals environments. So it is not the case that I'm saying deals are bad and rules are good for growth. What I'm saying is you can actually create an environment for much more rapid growth than typically rules with weak institutions could create with a closed order deal environment. So our model does not regard Bangladesh, most of the kind of standard discourse, I think, has to look at Bangladesh. I've seen a number of papers of like, Bangladesh is a paradox, Bangladesh is a puzzle. If institutions are so good for growth, then why is Bangladesh having such stable 20 years of growth with such weak institutions? Our whole premise of the model is all that's nonsense. That a closed order deal environment can in fact provide powerful expectations of the key actors to invest and innovate and create industries that lift the economy in a deals environment. So again, I'm not saying deals good, rules good, deals bad. I am saying rules stable, deals can produce very high rates of growth, but the transition of the deals environment is often what creates the massive shock that causes extended stagnation. So for instance, obviously China is not a rules economy. China is a deals economy in which a single dominant political power kind of calls the tune. And if if you dare to stand up to them, they can shut your business down like that, right? At the same time, as you point out, it's been a very stable deals environment in which, for the most part, there's a high degree of predictability of what the deals available are and how those are directed in a certain way by the people who are in power. So again, as long as that persists, one would expect China's growth to persist. So I'm puzzled by your thinking that my model doesn't incorporate political and economic structural realities. Is that's exactly what it does. The nature of the deals environment is a political outcome and is the result of the political structures. So there's nothing politically neutral about or ignorant of politics in this model at all. And secondly, it's exactly about your economic structure. Precisely what the standard macroeconomic characterization of growth ignores is the structure, whereas exactly what I'm saying is you need to be sensitive to what your actual structure of your capabilities is and how that embeds in the world system. So I feel I'm saying much more of what you're saying. And in our model, again, Bangladesh is not a puzzle. Bangladesh is an illustration of our model rather than a puzzle for our model, in the way that I think it is rightly regarded as a puzzle for the good institutions model. Whereas we're not, this isn't good institutions lead to growth. That's bullshit. Good institutions don't lead to growth. Those were some of the slides I skipped, but good institutions are not predictors of rapid economic growth rates at all, but they are a predictor of the stability of the growth rate. It's a very different thing.
Actually, if I may come back on that, you see, much again depends on how you describe a closed order deal and the particular characteristics within a country which would make it classifiable as a closed order deal country. Here, if you look at various countries, it's a question of whether you simply attribute the stability to explaining that this is a closed order deal country without actually explaining whether the country is a country which you could be classified as a closed order deal. So, I mean, we've had this argument before with Mirza and with Salim and others when they've been presenting these ideas. And of course, Mushtaq has also contributed to this discussion. But I have never quite understood the classification of Bangladesh as a closed order deal country. I don't think it is any such thing. But if you are explaining Bangladesh transcending its sort of institutional anarchy by the fact that it is a closed order deal country, I am not persuaded by that argument at all, because it is predetermining the description of a country by relating it then to an outcome in terms of its sort of stable growth pattern. That merely because it's having stable growth, it must be a closed order deal country, but you still have not elaborated what determines whether this country is or is not a closed order deal country.
I think, so one of the things about—
I mean, I would certainly question whether we would be classifiable under those terms.
Yeah, but again, the classification, again, I'm not so crudely intellectually naive that I have a circular definition. We don't classify countries as closed order deals on the basis of economic outcomes. That would obviously be circular. On the other hand, one of the essences of a closed order deal environment is there's a massive disjunction between the legislation as it stands and the way in which it's enforced, which almost necessarily means there is not transparency about it. So it's very difficult to say, oh, here is my neutral objective indicator of a closed order deal country based on open and transparent data. That's precisely what won't exist. But let me give you examples, which I think you would agree ex ante. In Egypt, in the period before the fall of Mubarak, 80% of all formal sector credit went to firms connected to the Mubarak clan. I would think, independently of whether Egypt was growing or not growing, we could say that there was political favoritism in the allocation of formal sector credit if 80% of the credit was flowing to Mubarak, demonstrably Mubarak family connected firms or enterprises. Similarly, in Tunisia, after the fall of Ben Ali and which again, classic transition, ex post, you can document that the regulatory environment that existed was massively differentially in favor of protecting the interests of firms and enterprises owned by the Ben Ali family and connected people. So again, I think it is not that I'm saying it's a closed order deal because it has good growth. I'm saying it's a closed order deal because when you look at what actually happens in the economy, certain actors are their economic enterprises. I lived in Indonesia for 2 years. In the Suharto era, there was no question as to how the economy was structured, and it was structured such that certain small numbers of named sets of actors were the only actors that essentially could compete or be in certain large-scale industries. So it was the Suharto family, the military, and a very limited and named number of ethnic Chinese conglomerates and a few other domestic enterprises. And all of the major enterprises were dominated by members of one of those groups. And because they received massively differential favorable treatment in the way in which the economy was run, organized, regulated, and taxed, et cetera. So I think there's an obvious independent observational basis of whether an economy is a closed order deal economy independently of its economic performance. So we can, in fact, classify them but that said, if you ask me to come up with, well, what's your doing business indicator indicator? Well, the whole point is the doing business indicators are ridiculous and stupid because they pretend the world actually exists in a world in which all firms face the same climate for doing business. Whereas the whole point of a deals economy is not everybody is subject to the same climate, right? There isn't a climate for doing business. Some people live in hot houses and some people live outside the hot houses, and the environment for doing business is completely different. But that requires direct observation on the gap between the legislation or policy and the actual practice. And that is precisely what's not going to be available in some neutral, objective, comparable way. So I agree that we have a difficult time classifying countries precisely because what a closed order deal economy is pretend that it's not a closed order deal economy, or makes as little transparent as possible the differential favoritism that certain large business houses are receiving as a result of being favored. So it's not a circular definition at all. And that said, precisely one of the lines of research, and we can send you the papers, is we show that these doing business indicators, for instance, are massively differential across firms. So when you ask firms, how long did it take you to comply with this or that regulation? The doing business indicator gives you one number for the whole country. Whereas when you actually ask firms, you get a complete total range of what could possibly happen as their reaction to how much time or effort it took them to get certain things. So you see in the data that firms report massively differential treatment in their actual doing business. So I think we have a lot of micro evidence that there is hugely differential environments that firms face, and a lot of evidence that in country after country, the structure of the politics and the economics are intertwined in such a way that a limited number of actors, often in a limited number of industries, both receive favorable treatment in a whole variety of ways: regulatory forbearance, access to credit, et cetera, et cetera.
Thank you, Lant. I think it was so rich discussion, and I wish we can continue on this deals environment, especially with Professor Evan Sohan. I just want to add one thing is that since I was also part of this work, that when we talk about deals environment, actually it's also about the phases. It's not that when one particular point of time we can see the dominance of kind of closed order, and one particular point of time probably it can move from closed to or open order. But we are also forgetting another aspect of deals environment. It is actually the ordered or disordered, I think, which is also extremely important, whether in terms of generating, if it is generating growth. If it is disordered, then definitely unpredictability and or lack of credibility of the policies, all these things will also affect growth. And also, I think Professor Lant Pritchett's last point on the business environment, the business climate, and I think this is also extremely important that the firms, they experience very different kinds of different business environment. And also, it's not only the World Bank's doing business survey. I think that's a very, very kind of wrong in the saying that one particular number is applicable for all the firms. But when World Bank comes up with their farm level survey, I think that we see the very differential impact at the farm level. So I think that also will definitely affect the recovery process, because in this COVID situation, not all farms, they will be experiencing, the different same kind of treatment from the government, and probably citing the experience from Bangladesh. We're also seeing that probably the most dominant farm, they are receiving the most of the privileges, and while the most of the micro, small, and medium enterprises, they are actually lagging. So I think those things will also affect the recovery process of the economy and how things are being determined. So may we now move to the next question? Who wants to? I think Professor. I'm just checking, Professor Mustafizur Rahman, you still are with us and want to ask any question? If not, I can see one question at the chat box. Mr. Mofakhar Hussain, are you with us here? If you are with us, you can pose the question, or I'll read out for you.
I'm here. Can you hear me?
Okay, please. Yes, we can hear you. Can you very briefly pose your question, please?
Yeah. Okay. Thank you, Dr. Lant. Thank you for the presentation. Wondering if the huge growth variances that you're seeing in developing countries, wondering that happened in the developed countries in the pre and post-industrial revolution era, right? So that's when this was going on. And my second question, I forgot my second question. Let me just repeat. My second question was, so you appear to, I mean, this is something that we have been discussing, that rule of law apply to growth, and that we have already had that discussion. And my third question was whether human capital formation, a high level of human capital formation, allow a country to weather growth shocks. Thank you.
Over to you, Professor Pritchett.
Yeah. So the first thing, and I'm going to have to draw a graph with my hands here. The first thing is that there's a lot more volatility in the world, I think, relative to the pre-industrial period, because in the pre-industrial period, the gap between the rich and poor countries was actually quite small. And hence there wasn't that much downside, but the available capability, technology, et cetera, in the world was also very small. So you couldn't have big booms. And what has happened since the Industrial Revolution is obviously the leading countries relative to the lagging countries have taken off, which means that, for a country near the bottom, the upside availability is just enormous. So the growth rates observed by, for instance, Bangladesh over the last 20 years, the highest growth rate of per capita GDP in the pre-industrial period was like 2.5%. Because you were pushing the frontier of knowledge to increase growth at any given time. Whereas again, in the world today, the capabilities and technologies exist and are being utilized in countries around the world. So the upside has come off, right? But by the same token, there's lots of countries kind of in this middle space of 10,000, 15,000 GDP per capita, which means if you screw that up, you can go back to 5. So I think the answer is yes, the volatility in absolute terms is much, much larger than it was before, because as I said before, this isn't a pessimistic story. This is a variance story. The upside is just unbelievably high relative to the upside in 1870, in which the richest country in the world really wasn't that rich. And then the downside is also larger because so many countries have moved in this middle to where they have further to fall. So it's a volatility and it's a variance story. And by and large, it's an optimistic story because as more countries move into this range, the upside is there and the downside is there. The human capital question is very interesting and important because I think people, I'm trying to think of a careful way to say this, but people, I think, place entirely too much faith in human capital. Human capital can be used in ways that are disastrously bad or time or limiting. And so having high human capital is not necessarily a good thing. So let me start from Douglas North, the kind of dean of the institution school. You know, Douglas North pointed out that being a pirate is an enormously high human capital activity. You need to know trade routes, you need to know artillery, you need to know shipping, you need to be able to lead people in a common endeavor. You know, it's not that, you know, the people just stealing gold and shipping it across the Atlantic were probably lower human capital than the pirates who had to be innovative and entrepreneurial about robbing it from them. So I think the distribution, one of the things about our closed order deal environment is that, you know, being a lawyer who cuts the best possible deal on taxes with the government by negotiating extremely obtuse and hard to understand but enormously lucrative loopholes might well be the highest human capital people in your country. But as you get more and more of those lawyers, you're not going to become more productive because it's all essentially a high human capital competing to redistribute rents versus high human capital competing to become more productive. So the former Soviet Union actually had much, much higher, at one point, countries in the former Soviet Union had measured levels of both education and quality of education that was roughly twice Southern Europe. So Hungary was twice as educated as Spain, and yet Hungary's GDP was a third of Spain's. So I'm a huge fan of human capital, but one of the downsides of weak institutions is in an environment of weak institutions, the optimal private use of human capital could well be generating massive negative externalities for the rest of the economy by creating a rentier economy. So I worry about the allocation of human capital being distorted by the structure of economic activity away from productive to redistributive purposes. So in and of itself, that can be a vicious cycle in which people are competing for entrances into universities because they know entrances into universities equip them to be part of the rent distributing elite.
Thank you, Lant.
Thank you.
Selim, can I?
Yes,
Yeah.
yes, of course.
No, thank you, Professor Pritchett, for a very interesting presentation. My question was with regard to the example of, for example, you mentioned about the doing business ranking, and it is a country ranking, and you are very right that the impact could be different because the big houses, they can bypass and they can make deals, etc., which the smaller enterprises cannot. But on the other hand, if we have weak infrastructure, for example, ports, connectivity, or we have low human investment in education, human resources, then even for the larger firms who are making the deal, this becomes binding constraints at some stage. So, so that can undermine the sustainability of growth at some point, even though at a particular moment in time, they can do away or they can overcome this through deals. So from a sustainability of growth perspective, would you agree that at one point of time, if some firms are able to make deals at some other, it will show up, later on in terms of their growth in future?
I know I absolutely. Like I say, I don't. Let me repeat. All of the observed rapid growth episodes that we have seen have happened, in my view, in an independently classifiable closed order deal environment. And that can often persist for a very long time. And the key question, and this is the economic model that I would encourage anyone out there that wants to do a path raving PhD to think about. I think, as you're saying, part of the question becomes, do the people inside the closed order deal lobby for things that enhance the productivity of other sectors, or detract from the productivity of other sectors. So to the extent that you have a set of powerful business houses exporting something that requires good ports, and that leads them to lobby for good ports that actually operate reasonably effectively across the board, that's a terrific thing because that may make other industries possible that wouldn't have otherwise been possible. So there's a possible positive feedback loop in which what the powerful people inside the closed order deal environment lobby for actually creates a more favorable and more productive economy, including for people that they're kind of positive spillovers, right? So I fully agree there can be positive spillovers of a global, and what my take is not, oh, closed order deals, they're terrible, we need to shut it down, we need to, blah, blah, blah. It's, we need to think about the hard slog. How do we get the closed order deal environment that you have onto a favorable path in which there are positive feedback loop rather than negative feedback loops? Because there's a wonderful paper title out there about Eastern Europe in the immediate aftermath of the Soviet transition, the post-Soviet transition, called Seize the State, Seize the Day, in which, a limited number of firms kind of seize the apparatus of the state, and then they use the apparatus of the state to prevent any future productivity and to prevent others from entering. So again, the closed order deals can be on fundamentally different economic dynamics in which the feedback loops are more or less positive versus more or less negative. And that's why when these closed order deal environments end, they sometimes, if what the closed order deals happen has been a dynamic of undermining institutions and just increasing rentier, then when it falls apart, it collapses and you get really extended stagnations. Whereas I lived through the collapse of Suharto, and by and large, the closed order deal environment of Suharto, while it was unambiguously corrupt and reallocating rents, was also in fact creating infrastructure that could be used for other purposes. And hence you had a very short, but very sharp contraction. And by 5 years later, maybe not 5, but 6 or 7 years later, Indonesia was back to its previous GDP and growing because they had not devolved into this completely kind of winner take all closed order deal environment, but had been open enough. So again, you shouldn't read what I'm saying. I'm very leery about saying this maybe too bluntly, but I am not saying closed order deals environments are this terrible, terrible thing that we need to destroy and blow up immediately. I'm saying the path to rules goes through an incremental hard slog of closed order deals becoming staying ordered, but getting more open, bringing in more competition, creating more, moving through the structural transformation by a positive spillover loop. And that's a good thing. And I wouldn't, running the risk of destroying the order to get it open is often what happens politically. And then that can often blow up because then you get disorder for everyone. And once you get disorder for everyone, then you can get into a low or negative downward spiral. So again, don't read what I'm saying as entirely negative about closed order deals. It's that they can be on very different dynamics. And since they're on very different dynamics when you're in the closed order deal space, you get very different dynamics when it ends. So, Mubarak can have the Egyptian economy growing as it, recycles the formal sector economy through the Mubarak clan, but it wasn't creating positive feedback loops. So when it ended, sudden stop versus Suharto. So again, I think we need to be much more subtle and much more contingent about asking ourselves, how do we create positive feedback loops and a positive transition rather than sort of pointing out and saying, oh, closed order deals, therefore we need to blow the whole system up. If you blow this whole system up, almost certainly you get into a completely disordered environment. That's very difficult, then makes it very difficult to reconstitute any order at all. And what lack of order produces is not a better, fairer, or more productive economy. It produces kind of the disordered economy for everyone. So these are very...
But Lant,
I'm sure
from what I understand,
fairness, but fairness is going to come through hard slog, not through sudden stop, because you can't build the capability instantaneously. If suddenly you said we're going to enforce the rules for everyone as they're written, the whole economy would freeze up. Nobody can live by the rules in most of these economies. So I think we're at the end of time, aren't we?
Yes, a few more minutes. And Professor Sovan, I think he's asking the
I
final
was
question.
wanting to just ask you a question.
Yes.
In fact, this can go on for a very long time, but unfortunately, that's not how
We
it
would hope
works.
so. I hope I've
So,
said things interesting enough.
the question I was to put to you is that the critical issue is not the nature of the deal. The critical issue seems to be that what is done under any sort of deal. I mean, the Egyptian economy, as distinct from the management and direction of the Egyptian economy compared to the Suharto economy, was that the Egyptian economy was a lousy project. And even when it had growth, God alone knows how they got the growth, because they were not just corrupt, they were inefficient and incompetent, and they left large segments of their population in poverty. That's why they revolted and threw him out. So the relevant problem is that under two closed order deal systems, one managed the deals very different. One managed the system. I'm not particularly persuaded by this whole deals concept anyway, because much really depends on who is there and how effectively they are actually set about managing the economy, and whether they are creating both a level of efficiency and growth, as well as a certain element of distribution of the gains from growth. All these depend on how the game is being played out by the captain of the team.
I know that we
So
can
that
actually
seems
go
to be
on
the
and
more central element.
No.
I'm having a hard time, other than you're objecting to the word deals, I'm having a hard time to seeing how what you're saying and I'm saying is that different.
Yeah, I also don't see much difference. Probably this is the difficulties with the digital environment.
I like the word deals because you were about to say what everybody says is the rules of the game, right? It depends on the rules of the game. But the point is, the rules of the game can be, the rule is different for you than it is for me. There was a famous president of Brazil who is famous for saying, "For my friends, anything; for my enemies, the law." So once you have in place,
that sounds kind of familiar over here.
Exactly, and so once you have in place, in some sense, the appearance of a very restricted and regulated economy, that creates all kinds of options for differential regulatory enforcement or tax treatment or regulatory treatment or et cetera, and then it's very easy to get into a situation in which the rules of the game are that there are no rules. It's what you can negotiate with whom you can negotiate it. Now, that said, I hear myself agreeing that the way in which that closed order deal structure can put you on a largely positive dynamic or a largely negative dynamic. But what we're saying is, again, more about variance, which is growth can be high in a closed order deal environment and high in such a way that when that particular deal environment ends, say through a regime shift, one continues with relatively high levels of productivity, or it can be such that you're not actually creating any underlying productivity in the non-deals part of the economy, such that when it collapses entirely. So the management of the closed order deal process is in fact a key determinant of the long run outcomes in the post, what happens after the end of a particular deal environment. And where you get massive stop-start growth is when you move into a very closed order deal environment in which you're primarily reallocating rents with no positive spillovers of productivity. And when that ends, because the few sectors around which that deal had been constructed evaporate, as in the Liberian case or in resource cases, then the whole economy can come apart, versus if you're in fact using the responsiveness to deals that the one question was asking to create more infrastructure and to create more favorable things and create new technological embeddedness into value chains and et cetera, then those persist past the deal structures end. So.
Well, many thanks, Lant. I think that was fascinating discussion. Actually, I wish we could actually go on and on, but we look forward to the other session. But I don't want to really miss one opportunity to ask you the final question, and just seek your just for a few more minutes. In your blog, your last blog, you wrote an article, and it's That was on May 12th. Why I won't sell Best Buys and why you should not buy them. So and you talked about those best practices to avoid those best practices. Given the current context, the COVID situation, where countries are actually struggling to recover and to manage this crisis. Yeah. So what would be your suggestion, for a country like Bangladesh, Nepal, or in South Asia, India, Sri Lanka, Pakistan? They should avoid the best practices or the best buys? What did it really mean? When you mentioned that.
I think maybe in the context of creating a new set of visa restrictions of who can come to Bangladesh visa their infection status, you should include a possible infection being the word best practice and just ban people who use the word best practice from coming to Bangladesh altogether and reduce the vector of transmission of best practices. The fundamental fact is practices have to be adapted to be adopted. And best practicism is actually a disease that gets transmitted by vectors, like regular diseases get transmitted by mosquitoes or being in a room with other people. And the real problem with best practicism is it creates the environment for deals, and people don't see this, which is if you adopt best practice as the legislation or the official or de jure policy, that's far beyond your actual endogenously and organic developed capability inside the organizations in the country to implement it, you necessarily create a gap between reality and practice. The gap between reality and practice inevitably becomes a source of deals. And then once you have created the gap between reality and practice as a source of deals, you are embedded in a very negative and very difficult to get out of environment. So, good laws create corruption. If you adopt a law that isn't already quite near the achievable practice in your country, and you adopt this beautiful law that you've adopted from some other country, and here's your capability to enforce it, into that will rush the politics of deals making, and you're going to end up in a low-level equilibrium trap in which the politicians benefit from having a beautiful law because they can sell regulatory forbearance from the law. The people who get the forbearance love the beautiful law because it prevents any competitors from coming in, like, for instance, international actors and multinational actors that might have to actually play by the rules of the game. And the advocates love the beautiful law because it appears to be beautiful. And then you've got no forces for let's create an environment for Bangladesh, by Bangladesh, that Bangladesh can actually work with, or that is happening all behind the scenes, which creates kind of political traction, political friction and traction, because everybody knows the economy isn't being run in the ways that it says, and it creates unnecessary political resentment relative to saying, we are working with what we can do in Bangladesh towards the Bangladesh we envision in the future. And we might eventually get to where Bangladesh is best practice, but we are not going to get to where Bangladesh is best practice by adopting best practice from anyone else.
Thank you, Professor Pritchett. Thank you so much. I think that was so provocative. I wish we could actually have a long discussion even on your last point. And I'm quite sure there are some friends from media as well. I'm quite sure they will ask me questions after the session, what did you really mean out of that? But thank you so much again. I thank all the participants, especially Professor Raymond Sohan, attending this session and also interacting with Professor Lant Pritchett. So Lant, thank you again. And I look forward to meeting you in person and sometime in the near future.
I've been to Bangladesh and I'm happy to come when and if.
Of course, of course.
When and if.
I remember those tables of deals and the graphs. Actually, those were generated sitting in Sanem office, in our conference room. So thank you so much. And so everyone will join at 6:30, 12 minutes from now for the next session.